A slow week is coming to an end, and we open a window to what next week has in store for the markets. On the monetary front, a number of policymakers from various central banks are scheduled to make statements and could sway the markets. As for financial releases, after a quiet Monday on Tuesday, we note the release of Japan's corporate goods prices for January, UK's employment data for December, Switzerland's January CPI rates, German CEF indicators for February, and highlight the release of the US CPI rates for January. On Wednesday, we get UK CPI rates for January and Eurozone's revised GDP rate for Q4. On Thursday, we start with Japan's GDP rates for Q4, Australia's January employment data, UK's preliminary GDP rate for Q4, the Czech Republic CPI rates for January, Canada's house starts for the same month, and manufacturing sales for December. And from the US, we get the weekly initial jobless claims figure, the Philly Fed Business Index for February, as well as January's retail sales and industrial production growth rates. On Friday, we get UK's retail sales growth rate for January, the US PPI rates for the same month, and finally the preliminary US University of Michigan consumer sentiment for February. The USD is about to end the week relatively unchanged against its counterparts. On a fundamental level, we tend to maintain our worst for the banking sector, with the incident involving New York Community Bank forcing us to concentrate on medium-sized companies of the sector. On a monetary level, once again, we note that comments of Fed policymakers tend to underscore the possibility that the Fed is to maintain high rates for a longer period than what the market is currently pricing in. Should market sentiment continue to be contradicted, we may see the market being forced to reposition itself further, and that may keep USD supported on a monetary level. On a macroeconomic level, we note the tighter than expected employment market as reported by the US employment report for the past month. Last Friday, with the rise of the NFP figure taking the markets by surprise, the release provides more leeway for the Fed to maintain rates high for longer. Also, the higher than expected ISM non-manufacturing PMI reading for January, implying a wider expansion of economic activity in the sector, tended to underscore the narrative for a soft landing of the US economy. The pound is about to end the week relatively unchanged against the USD and the euro, yet seems to be gaining against the JPY. On a macroeconomic level, we still note the cost of living crisis, which tends to lower the living standards in the UK as possibly the main issue. Yet on a monetary level, we do not see any signs of a possible easing of the tight financial conditions in the UK economy yet. The bank's stance, as expressed in its latest interest rate decision, was underscored by BOE's chief economist Hugh Pill on Monday. That tends to highlight the release of the UK CPI rates for January next week. We expect the rates to slow down, which in turn may weaken the pound as the pressure on BOE to start cutting earlier may rise. Yet it's not only about inflation. There are worries for the economic outlook of the UK, also on the growth level. In the coming week, we are also getting the preliminary GDP rates for Q4 and another contraction on a quarter-on-quarter level, which would technically be signaling the entering of the UK economy into a recession, could weaken the pound. JPY seems about to end the week slightly lower against the USD, Euro, and the GBP. The main issue for the JPY its dual nature as a safe haven and a national currency. Hence, a possible improvement of the market sentiment in the coming week may weaken JPY, while a more cautious approach of the market may provide safe haven inflows for the Japanese yen. On a monetary level, we note that BOE will be exiting its ultra-loose monetary policy, yet any change is expected to imply by BOJ policymaker Uchida in statements made on Thursday. Should the bank continue signaling a return to a normalization of money, we may see JPY getting some in. The common currency seems about to end the week unchanged against the US dollar and the pound, and is edging high against the JPY. On a fundamental level, We note the ongoing protests of European farmers, with major European cities being under siege by tractors. We still expect the issue to escalate further before actually being resolved, and could start weighing on the common currency in the coming week on a fundamental level. On a monetary level, we know that ECB seems to be expecting inflation to come down earlier than initially expected, at least according to their AI model. On the other hand, ECB's chief strategist Lane seems to be placing substantial weight on how wages will be behaving over the next few months and their effect on inflation, which may delay any interest rate cuts a bit. Hence, should the bank continue sending out signals that it will delay any rate cuts, we may see the euro getting some support, yet we tend to see the ECB as the primary candidate to start cutting rates first among central banks of developed economies, given that inflation seems to be nearing the bank's target. AUD is about to end the week lower against the US dollar for a 6th week in a row. On a monetary level, we know that RBA remained on hold as was widely expected, yet the bank has reiterated its concerns that inflationary pressures still remain high in the economy. In particular, the bank stated in its accompanying statement that a further increase in interest rates cannot be ruled out, implying that the bank may increase its interest rates in the future, which could maintain the Aussie supported on a monetary level. On a more fundamental level for the Aussie, we note the worries for the Chinese economy given the close economic ties of Australia with China. The deflationary pressures on a consumer level in China tend to highlight difficulties in the recovery of the Chinese economy. Also worrying for Australian exporters of raw material to China are the even wider deflationary pressures on a producer level, making the bargaining of Australia's raw material selling price even harder. On a macroeconomic level, we note the release of Australia's employment data for January as the highlight of next week for Aussie traders. The CAD is about to end the week relatively unchanged against the US dollar, yet Canada's employment data are still to be released and could change the picture. On a monetary level, we note that the bank's January meeting deliberations, the bank seems to have hesitations about easing its monetary policy given the uncertainty of the outlook of inflation. It was recognized that the bank's tight monetary policy seems to be bringing some results in easing inflationary pressures in the Canadian economy, yet inflation seems to be coming down slowly. Any further signs that the bank intends to delay any rate cuts may keep the loonie supported in the coming week. On a fundamental level, we note the path of oil prices. Oil prices seem to have been on the rise since the start of the week, as tensions in the Middle East tend to intensify market worries for the supply side of the commodity, and should they continue to do so, they could provide support for the CAD as well, given the positive correlation of the two trading instruments. In the coming week, given the lack of high-impact financial releases, we expect fundamentals to lead the way for the loonie. As a general comment for the coming week, we expect volatility to rise, possibly with the USD increasing its influence in the FX market, given the gravity and frequency of high-impact US financial releases. As for US stock markets, we highlight that the earnings season may have kept equity bulls afloat in the past few days. Yet, on the other hand, comments of Fed policymakers contradicting market expectations for extensive rate cuts tend to weigh on US stock markets. In the coming week, we note the earnings releases of Airbnb, American International Group, and Coca-Cola Lyft on Tuesday. On Wednesday, we get Cisco Systems. On Thursday, Coinbase, Dropbox, and on Friday, Baidu. As for gold, we note the relative stabilization of its price, taking advantage of the USD's inactivity, which tends to be in line with the negative correlation of the two trading instruments. Furthermore, we note that the drop of US yields at the beginning of the week has been recovered, and they are now at the end of the week near the same levels they began. Should US yields continue to rise in the coming week, we may see gold's price slipping as market attention may shift increasingly towards US bond market. On the other hand, should we see the US dollar falling in the coming week, we may see gold's price getting some support. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
My name is Emily and welcome to another of our great educational trading videos. Today we're going to look at day trading. Day trading is a very popular short-term trading strategy that involves the buying and selling of financial instruments during the trading day in order to make a profit from small price movements. The most important rule of day trading is that traders need to close out all their positions at the end of the trading day. Generally, the day trader aims to take small profits that can add up during the day or trading period, while at the same time minimizing their losses. While day trading is a viable trading strategy for many experienced forex traders, beginner traders could find day trading to be challenging. Without a well-defined trading plan and the discipline to adhere to its rules, beginners might be overwhelmed by the stress of intraday trading. Day trading strategies can differ from longer-term trading strategies as they focus more on profiting from shorter-term movements in the market compared to moves that take place over a number of days or weeks. In this respect, day traders need to be continuously focused as markets can move suddenly in the short term. Overall, advantages of day trading include instant results and no overnight risk. On the other hand, the disadvantages include requiring a high initial deposit to make substantial profits, less time to think, and there is also a risk of overtrading. Thank you so much for watching us today, guys. Bye-bye.
Started. So sorry about that. I for some reason could not turn on my camera. Okay, but let's just get into it. So as per usual, a risk warning and disclaimer first. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So do your own due diligence before investing any of your money. Hey, I'm Melanie, and I will be your speaker for today. I'm an investment analyst from Everest Virtual Group, who are finalists for Best FX and Equity Research in 2019 to 2021. So here's our agenda for today. We're going to understand what makes a valid trend line and trend channel, what exactly are breakouts and fakeouts, and we're going to look at some indicators to determine momentum and look at improving the probability of successful breakouts. Okay, so let's start off with trend lines. So here's what makes a valid ascending trend line. Firstly, they should be drawn from the bottom if it's an ascending line and not the top. Next, trend lines should have at least 3 significant touches, and 2 touches tend to be more coincidental, which is why we typically would recommend 3. So here are a couple of examples. Okay, you can see how significant exactly these troughs should be, or the swing lows should be, in order for them to be considered valid points on a trend line. Okay, here's another example, and here is an example of a descending trend line. So Similarly to ascending, they should also have at least three significant touches, but for descending, they should be drawn from the top and not the bottom. Okay, here's another example. In this case, we have really nice four swing highs that touch our trend line. Okay, but three is enough. Here's another example. Okay, so here we've drawn out exactly how significant these touches need to be for it to be considered valid. And then we want to watch out for at least three significant touches, because then there could be a possibility that price would likely react off of that trend line again, which you can see is what happened here. Okay, so price actually reversed back to the trend line and is playing the reaction off of the fourth touch. Okay, now pretty straightforward. So let me know in the chat whether you guys think that this is a valid trend line or not. It's not. Yeah, Victor, yeah, trend here is down. Yeah, so it should be drawn on top. Yes. Okay, yeah, pretty straightforward. I think you guys have gotten it, so let's just move on. So now we're gonna look at drawing trend channels. So for trend channels, they require at least four significant touches. So two at the top, two at the bottom, and they don't need to be in consecutive order, like in this image here. Okay, so for example, over here, this is also consecutive, as in top, bottom, but it can also be top, top, bottom, bottom, or bottom, bottom, top, top. Yeah, so the order doesn't really matter as long as it's significant, swing highs and swing lows, and they touch your channel four times. Okay, this is an example of an ascending trend channel. Okay, now let's take a look at liquidity traps. Okay, so what exactly is a liquidity trap? So it's basically a situation in which monetary policy becomes ineffective in stimulating the economy, even when interest rates are near or at zero. So this occurs because people and businesses are hesitant to spend their money, even at low borrowing costs, leading to a lack of demand for goods and services. So in the context of trading, a liquidity trap can cause problems for market participants as it may lead to a decrease in market liquidity. So that basically means that it will be more difficult for traders to enter or exit positions quickly and at their desired prices. So this can result in wider bid-ask spreads, increased volatility, and decreased market efficiency. So central banks actually try to address liquidity traps by using unconventional monetary policies. Okay, so some of these include quantitative easing. So they inject more money into the economy so that they can encourage spending. However, the impact of these policies on financial markets can be difficult to predict and may lead to unintended consequences. So here's an example of a liquidity trap. Okay, so firstly, we see price reversing at the swing high. Once price surpasses the swing high resistance, right, it clears the orders and then it drops below the resistance again. Okay, so another example here, price breaks out of the ascending trend line as well as the ascending trend channel. So it shoots out of it, clears the orders, and then at the point 1.04791, this swing high price reversed and it proceeded to drop back down. Okay? Okay, now let's combine trend lines, trend channels, support lines, pullbacks, and overlaps. Okay, here is just a checklist. Okay, so you can screenshot it if you want. I'm just gonna get rid of my face. When I was starting out with technical analysis, this checklist was really helpful for me. Yeah, but it's just a list of things to look out for. You can find this checklist and other tutorials on the forexarmy.com website as well. But basically, for this checklist, it just tells you that if you combine multiple technical analysis methods, um, your analysis would then be more accurate. Yep, I'll just type into the chat. Just forexarmy.com. Okay, maybe I'll show you guys what the website looks like as well. Okay. Mm, this Forex Factory, sorry. Forex Army, this one. Okay, so actually it's theforexarmy.com. Okay. So here you'll find some trading guides. So we have guides on Fibonacci, support and resistance. We also have trading tools that you can download for free and just implement into your MT4. Okay. Yeah. So we have Fibonacci, how to draw it correctly, support and resistance, and a couple of MT4 downloadable trading tools as well. Okay. Let's see. So yeah, this really in-depth and really easy to understand Fibonacci guides, as well as some risk management techniques. So this is really important. Support and resistance. So all of these as well. Yeah, okay. You can go and explore this website on your own. Okay, so here's another checklist. So this is specific to playing the continuation. So you can play the bounce or reversal by firstly checking whether price respects the Ichimoku. Secondly, trend line, key horizontal support or resistance levels, any key Fibonacci levels that it is near. And these are the 4 Fibonacci techniques that we use. And where's the next key level that it might go? So you fine-tune these levels by looking for confluence areas. So confluence areas tend to be a mixture of Fibonacci levels as well as horizontal levels. So like your overlaps, pullback levels, as well as pivot point levels if you do use that indicator. So when you find a couple of levels that match up at the same area, it doesn't have to be a level, it can be an area. As long as it's close together, that's fine. Yeah, then that is more confirmation that your analysis is correct and that price is likely to be attracted to that level. Okay, so in this example, I have an ascending trend channel. Okay, and price is moving within the trend channel. So in this case, I'm playing the continuation. and the continuation in this case is simply an uptrend. Okay, and when I say bounce or reversal, I'm looking at price bouncing off of the trend channel, which you see over here. Bounce off it, it moves within the trend channel. So that's why we say continuation. Okay, next, another example, but in this case, it's a downward trend channel. So same thing, we are looking at playing the continuation. Bounce or reversal refers to price bouncing off of the trend, the sides of the channel, which you can see over here. And it happens multiple times in this chart. Okay, so if you were to put your entry over here and made a buy entry to this trend channel here, and then you did that a couple of times, it would have been really, like you would have made a lot of profit. Okay, now let's take a look at how we can play the breakout. So using the same checklist, is this the same checklist? Okay, not exactly, but looking at the same kind of indicators. Firstly, does price cross below the Ichimoku? So if price crosses below the Ichimoku, it suggests that the signal that Ichimoku is giving us is bearish. Do we have the Ichimoku momentum on our side? So is it bearish or bullish? Did price break any trend line? Basically, these three breakouts basically suggest that there is a change in trend. Okay, and then where is the next key level it could go to? Same thing over here, we are looking for confluence areas as well. Okay, playing the breakout. So first example here, I'm using a Fibonacci projection. So if you're not familiar with what a Fibonacci projection is, basically you're using the extension tool. If you're looking at TradingView, it's the Fibonacci extension tool, which has 3 points. So this is my starting, middle, and ending point. And in order to use this or to recognize that you can use it, we are looking for kind of a lightning bolt shape. So basically something like this, okay, and then it moves upwards. So, and for that, we use 3 levels, 61.8, 78.6, as well as a 100%. Okay. So I have a resistance level here. We have 2 swing highs, and then I have another, excuse me, swing high resistance here at 135.147. Okay, so from this level, price has broken out of this confluence area, this multiple swing high resistance. So it's broken out of it, so we're expecting it to continue to shoot upwards towards any one of these levels. Okay, and that's exactly what it did over here. So once price reaches our 61.8, we can expect it to continue, or once it breaks out of the 61.8, we can then expect it to continue to go towards our 78.6 level. Okay, and our 78.6 level is about the same level as the swing high resistance as well. So, yeah. Okay, now let's move on. So this is another example. In this case, we are looking at a descending trend channel. We're looking at descending trend channel firstly. Secondly, we are looking at this ascending trend line. But then we notice that price has recently broken out of this descending trend line, or ascending trend line. So it's broken out of the ascending trend line, suggesting that it's gonna move downwards. Okay, so 2 points, descending trend channel breaking out of the trend line. Next, we have price moving below the Ichimoku cloud. So remember I mentioned earlier that if it moves below the Ichimoku cloud, then it's a bearish signal. So we have three indicators, graphical and indicator, a momentum indicator that tell us that price is going to be bearish. Okay, so then we can expect it to continue towards this swing low support level here. Okay, and you can see that it definitely did hit where we expected it to go. Okay, another example here. Price recently broke out of the ascending trend channel, so that's point one. Point two, price is currently at this 127.2% level. So here we have a Fibonacci extension. So, okay, let me just go to our Forex Army website. If you missed our Fibonacci series, not to worry, but that's basically where we go through all of the different techniques in detail. Hmm. Okay, we might not have that here. Okay, we have this. These are Fibonacci expansions. So they go from 0 to the negatives. And these also use that same lightning bolt shape as the projection. Okay, I think we don't talk about extensions here. That's so weird. Okay, never mind. I'll just talk about it now. So for Fibonacci extension, we are looking at the above 100 range. So for the above 100 Fibonacci levels, we are looking at 127.2 and 161.8. Okay, and how you decide whether or not you want to use this level, you look for this shape, this like V shape. Okay, in this case, it's a little bit difficult to see because it's inverted. So it's inverted tick shape. But you can just imagine a Nike tick, just an upright tick. Yeah, so as long as the head of the tick is smaller than the tail and price retraces 100% of this initial shape, then you can go ahead and use this Fibonacci tool. Okay, so in this case, we see that price recently broke out of this ascending trend channel. It's also currently breaking out of this 127.2% level, Fibonacci level. So we're expecting price, once it breaks out, we're expecting price to continue to this 161.8. Okay, so 161.8 is also in line with this swing low support level at 0.66420. Okay, so we want to try and make sure that we line up Fibonacci with graphical levels as much as possible. And you can see here that that's exactly what happened. Okay, we see price break the level, the 127.2% level, and went all the way down to 161.8, just as we expected, caught our trade, and then shot back up. Okay, here's another example. So price recently broke out of this descending trend line. Okay. So using Fibonacci extension again, the same Nike tick shape. we can see price is currently breaking out of this 127.2% level. Okay, and we're expecting it to hit our take profit here at 85.724. That's in line with the 161.8% Fibonacci extension. Okay, and you can see that's exactly what happened here as well. So for our take profit, you can see that we have this 161.8 obviously, but it's also in line once again with a swing high resistance as well. And our buy entry, as you can see here, is also an overlap level because we have price reacting off of it from a swing low and a couple of swing highs as well. Okay, so that's all for my slides. Now I'm gonna go ahead and pull out some charts. So let me know in the chat if there are any specific charts that you'd like me to analyze. Okay, I'll just go ahead and look at gold first. Mm, okay, so let's start off with the higher time frames so that we get an idea of where prices are headed, just the general direction. Okay, we have 3 swing high resistances here, and we have price moving downwards. On our daily time frame, we have a swing, we have 3 swing highs that match our descending trend, our descending trend line. Okay, so this is a valid trend line. Okay, and maybe I'll just place my swing first resistance there and my second resistance here, or rather my first support here. And okay, so a good habit is to try and see how far back you can put your support and resistance levels. So the reason for this is because you want to see, it's easier to see how many times price has reacted off the level, so you know how significant that level is. And you can see that this level is pretty significant with price reversing off of it a couple of times. Okay, next we have another swing, another second support here. Or maybe closer here. Okay, yeah. So the reason why I chose here instead of there is because here we have many swing highs and lows. Okay. So here we are playing the continuation. Now that I have my Fibonacci levels, I'm gonna go ahead and add some Fibonacci levels to support my support and resistance levels. Oh wait, this is the daily time frame. Okay, I'm gonna analyze it on either the 1 or 4 hour time frame instead. Okay, so here's the 4 hour time frame. Let's see if we have a trend channel. Okay, no, we don't. Okay, but we can kind of, do we have a trend line? Okay, also no, because we have this area here. Okay, okay, we don't have any support, any trend channels or trend lines, but we will just go ahead and add some support and resistance levels now. Okay, so this is my first support. Okay, I'm just gonna make this a dotted line because price is super close to this level. But I want to highlight it because of this swing high here. Okay, and then a resistance here. And here. Okay, now let's add some Fibonacci levels. Okay, I can see that my 50% lines up with my first resistance. 50, 70, no. This is a little bit too far, but if your 50% is, like if you look at my 50%, it's kind of about my first resistance. So that's fine. Okay, next, let's add some okay, I have my 100% lining up with my first support. Okay, but this is no longer valid because price has already broken out of the 100%. So even though it does line up with my first support, I can't use that anymore. Okay, so sometimes you do see some charts that are a little bit more difficult to find Fibonacci levels. Okay, I can see that my 100% lines up, and you can see this shape that I'm using for my projection. So I'm using a projection, as you can see my 61.8, 70.6, and 100, and also these 3 points. So I'm looking for this kind of shape here. Okay, so my 100% lines up. Okay, and again, the level, or rather the tool that I use is this one over here, the trend-based fib extension. Okay, I think that's all the levels that we have for now. Now let's go in with some indicators. So over here, we can see that maybe, okay. Yep, so we can see that this 50% lines up nicely with my first resistance here. Okay, and we typically will trade according to the trend. So here we see that price is moving upwards. So we're likely to expect it to move upwards to our first resistance once price actually breaks out of this intermediate level. Okay, so let's pull out some levels to support this. Okay, and you can see price is moving above the Ichimoku cloud. MACD is also giving us a bullish signal. So I like to use MACD and Ichimoku because at one glance I can see exactly what the signals are. Okay. Okay. RSI isn't really telling us much. Now let me pull out my exponential and simple. So I like to use these two because not only can I check each indicator at the same time, but also I can see that when there is a crossover, that typically suggests that that the trend is reversing, or that the trend is changing. Okay, so here we can see that currently there is no crossover between the two, and in fact price is moving above our SMA, simple moving average. So it suggests that price is gonna continue moving upwards. Okay. Okay, let me know if there are any other charts you'd like me to go through or any other questions. Okay, if not, maybe I'll go ahead and analyze DXY as well. Okay, just before the inflation reports are released this coming week, I think tomorrow. Okay, so here's our weekly time frame. We see prices generally in an uptrend. Okay, but there is a slight reversal over here. Okay, let's look at our lower time frames. Okay, so earlier we talked about trend channels and the breakouts of trend channels. So this could be a possible breakout of a trend channel because we have two swing highs at the top as well as two swing lows. Okay, so this actually could be an example of a breakout as well. Okay, so we're still generally bullish on our weekly and our daily time frames. Now, if we take a look at our 4-hour time frame, you can see this uptrend over here as well. So also pretty bullish, except for this reversal here. Okay, but we typically will follow the trend. Okay, now let's get into our analysis. Okay. Even though our weekly and daily time frames give us a bullish signal, this is kind of bearish because price is breaking out of the trend line. Okay, so we'll just keep that in mind, the mix in signals, in graphical signals. Okay, and that's why we use indicators, momentum indicators, as well as Fibonacci levels and graphical as well. Okay, so this is my first resistance. Mm, let's see if there are any levels that are closer. Okay, I'll just leave my first support here at this swing low and then change this to second support because this level is closer to my first resistance. Okay. Okay, now let's look at our Fibonacci levels again. Okay, now I'm going to use my extension. So I'm looking at the above 100 levels. And you can see that my above 100 levels line up nicely with my first support and second support. Okay, so this is the V shape that I'm talking about. Okay, in this case, it's a bit inverted. It would be like that. Okay. Okay, I have a 38.2 and 23.6 level. Okay, that both line up nicely. Okay, so we already have this confluence area here. Okay, which is why we are seeing so much resistance here at this level. Yeah, I'm gonna put my second resistance here as well. Okay, but we can see that price is breaking out of our first resistance. So once it breaks out of this confluence area, we'll definitely see it approach our first support and the 127. And then subsequently, once it breaks out of that, we'll see it move towards the 161.8 because the 161.8 is, or our second support is also an area of confluence. Okay, we have the 38.2 and this 161.8, along with this second support, which, as I mentioned earlier, is an overlap level. Because you swing high here, swing high here, swing low there. Okay, so this is a confluence area, which means price is likely to be attracted to that area. Okay, now let's take a look at some indicators. Okay, Ichimoku is giving us bearish. MACD is also supporting our analysis. Let's look at RSI. Okay, RSI, let's see if we have a trend line. Okay, we do have a trend line on our RSI. Okay, so it supports our bearish signal as well. Okay, stochastic. Okay, stochastic isn't telling us much. Okay, we see that price crossover, okay, which means just after price reversed. So you see this uptrend here. This is what I mean by looking for a crossover when you're looking at EMA and SMA, because a crossover would typically mean that price is likely to reverse its trend, which is what we saw here. Okay, so definitely moving downwards, especially with price moving below both of these indicators currently. So overall, all of our indicators that we've used support our analysis. Okay, let me know if you guys have any other questions or any requests. Okay, if there is nothing else, yeah, hi. Yeah, Demi Lola. Yeah, feel free to type your question in the chat.
Okay, can you hear me now? Can you hear me?
Yeah, hi.
Yeah, hi. The first resistance is a bit low,
Mhm.
like the swing low. The
Um,
swing low, first resistance,
yeah,
swing low.
is
How
what?
they
Sorry.
come to that
How did I come
swing
to the
low?
first resistance?
Yes, yes, on the swing low. I mean, resistance supposed to be at the top, not bottom.
It is kind of at the top if I just zoom in a bit. Price has recently broken under it. Can you see? And also because over here, right, at this, let me circle it here. Okay. Even though this is a support, right? So you would expect it to be a support, but price has broken under it. Okay, so once it breaks under, it becomes a pullback resistance because we're expecting price to pull back to it.
Okay,
Okay.
okay. Because okay, the reason why you called it first resistance because it's the nearest it is the nearest I mean that's the last bottom, right?
Yes. It actually, okay, so a resistance, you're right, should be like this. So like at the peak, right? So you're right.
Exactly.
But in this case, because price has passed under it, so I'm actually using this as my level of reference because price has
Okay, in
passed
this
under.
case, okay, you mean once the price pass under it under the let me say the previous low, it's become a resistance level.
Yeah, so this is what we call a pullback resistance. Yeah. Okay, maybe I'll pull out last week's slides to show you what I mean because we still have a bit of time. So we covered this last week. Um, okay, here. Okay, so a pullback is like this. So resistance, similar to what we saw earlier, here is my support, right? Once price breaks under it, it becomes a resistance, a pullback resistance.
Okay, pullback resistance. Okay, once price break the previous low, it becomes pullback resistance.
Yeah, and then once price reverses back to that, it then becomes an overlap. So like over here in this example here, it's a pullback, and then if you look at the GIF, once it returns to that level, it becomes an overlap. So yeah,
Overlap. Okay, once it's gone too far, it become overlap.
yes. Okay,
Okay,
does that answer your question?
yes, I grabbed. At least I'll further my analysis again. But I understand what you mean by what is it called?
Okay.
There was the first resistance. The first resistance, the line you drew, which is the pullback resistance. I understand it
Yeah.
now.
But yeah, it is a little bit close to where price is at. So I understand your concern as well.
All right. Okay.
Okay. Okay. If
So
there are no other questions, yeah, then that's all for today.
okay, the second resistance. Sorry, the second resistance is is clear. It's clear to me. I mean, the first resistance should be at the peak.
Oh yeah, you can place it here as well. It's just that I prefer my resistance and support levels not so far away from where price is currently at. But yeah, it can be at the peak as well.
Okay. But why did you bring the resistance to the edge of the is it the edge? Is that the edge or neck?
Because of this swing high here.
Yes.
Yeah,
So
and because
okay,
I
so
prefer it a little bit closer to my current price. So current price is here, so I prefer it slightly lower, closer to where my current price is. But because our analysis anyway is we're expecting it to go down, so you can place it here as well. Because technically our second resistance would be our stop loss in this case, right?
okay.
So you could place it here as well. It's entirely up to you.
Okay, we are actually going for, in this case, you're actually going for a sell, not buy. So which means the second resistance should be the maximum stop loss.
Yes.
The first resistance, sorry.
Will be our entry, our sell entry. Oh, yeah, our sell entry. Then our first support would be our take profit. And then once price breaks that, then we can go in for another sell towards our second support. Yeah.
So how did you come about selling this chart?
Sorry?
How do you figure out sell in this chart?
How do I what? Sorry?
How do you figure out the charts? The market is going downward. How did you figure it out? I mean, it's going on the
Because
bearish.
yeah, because this ascending trend line, right? So we have an ascending trend line here, and price recently broke out of it. So it gives us a bearish signal. And then we also pulled out our indicators. So you see our MACD is giving us bearish signals. Ichimoku price is moving below the cloud. RSI is it's moving in this descending trend line. If I use the EMA and SMA, it's also moving below the indicators. So all of our indicators and our graphical analysis all give us a bearish signal.
Okay. I mean, I can see the RSI. I can see the RSI, which is quite short for me, which is giving us a bearish, it is giving us a bearish tone, and the MAC, which is the MACD, correct?
Yes.
The MACD is also giving us a bearish trend as well.
Yeah.
But for the MACD, I'm not familiar with it. The one I'm familiar with is just the MA, which is the moving average.
Yeah.
I'm just familiar with the moving average.
Just the Ichimoku and the MACD are pretty easy to use. So yeah, you can just read up on those and use them in your trading as well. Pretty easy to use.
Yeah, I will learn that as well. It's not part of I never use it for my analysis all the while because I use MA. That's what I'm being taught with. I use the moving average, but I think I will add RSI. Thank God for your analysis. I will add RSI to it. Let's continue. I will add RSI just to know my trend and to help.
Yeah.
The RSI is more I think it's friendly to be used.
Mm-hmm.
It's user friendly.
Yeah.
So and now I believe the RSI what is it called? The break on the chart. Sorry, I just hope I'm not just popping more question on you.
Sure.
Okay. I just want us to be on the same page. The RSI has confirmed the bearish trend. What else again confirm the bearish trend?
Okay, there are a lot of ways to use the RSI. Here I'm just looking for a trend line here. You can also look at so if you enable the lines, so the upper and lower lines. I mean here, the upper and middle bands. Right? If it's above the upper band, okay, let me make it bigger. So if it's above the upper band, it's oversold. So it suggests that price is gonna drop, as you can see here. If it's below the lower band, it means it's sorry. If it's above the upper band, that means it's overbought. So we can expect it to drop. If it's below the lower band, it's oversold. So we can expect it to go up. Okay, that's another way. Yeah, another way is by looking at divergences, but we have another webinar for that, so you can stay tuned for that as well. So we'll go more in depth because I don't really have the time to go in depth right now.
Okay.
But yeah, those are the 3 ways that you can use RSI.
Okay.
Yeah. Okay.
What
That's
about
all the time that I have for you guys today. Thank you guys so much for joining me. Yeah, I hope you guys learned something and found this helpful, and I will see you guys again next Wednesday. Thanks, everyone. Bye.
all right, thank you. Bye.
Bye. Thanks, everyone.